Hey everyone, in today's episode I'm going to walk you through how to value a real estate investment property so you can make smarter decisions and maximize your returns. There are three key ways to value an investment property. 1, the comparable sales approach, 2, the income approach, and 3, the cost approach. Let's start with the comparable sales approach. This is where you look at recent sales of similar properties in the area. It gives you an idea what buyers are willing to pay based on the market trends. The income approach values rental properties based on their ability to generate income. First, calculate the net operating income, the NOI, by subtracting expenses from rental income. Then divide the NOI by the cap rate to determine the property's value and potential return on investment. And lastly, the cost approach estimates the value based on how much it would cost to rebuild the property from scratch. This method is often used for newer properties or unique properties that don't have many comparables. But it's not about the numbers. Location, conditions, and market trends are all vitals to property's value. A great property in an up-and-coming neighborhood will likely appreciate better than the one in a declining area. For more advanced investors, there are also split-rate capitalization, a method that applies different capitalization rate to different time periods based on how secure or uncertain the cash flow is. It's a great tool for long-term projections. Understanding how to value a property helps to reduce risk, increase cash flow, and earn greater returns. Ready to get started? Reach out to me for strategic advice on your next real estate move. I'm Yael Shanee, your trusted real estate expert, helping you make smart decisions in real estate.